On a valuation standpoint, Okta, 32% margin of safety, a fair value of $155, currently at 105.08, so $50 higher from here. A $18 billion market cap, 27% and 32% forward free cash flow margin rates, really, really good for their business. Stock-based compensation's not too crazy. They do need to control it a little bit because they're only like 200 million off from what they're making in their free cash flow. So I'd like to see that reined in a little bit. Their net cash, the net debt, they have $1 billion over net debt, and outstanding shares only 171 million. And then you have your just great free cash flow yields of like almost 4% for forward and current, and then pretty reasonable PEs of 37 and 33. Reasonable, but also at the same time, the growth is, low teens and getting down to 9%, so high single digits. 37 and 32 is a little expensive for that type of growth, but these are analyst growth rates right here, and being very conservative in my opinion, because I actually believe that they can grow a lot faster in the realm that they're in, and we could see their revenue, continue to spin up to mid to high teens, and that would obviously well more justify the PE ratio. But besides the PE, I mean, I would really say all other indicators really point to this being a buy right here, right now, and to continue to buy it through June and for the rest of the year, as long as you stay 20% margin of safety or higher. You have a 10 to 20% CAGR based on discounted cash flow and EPS here. Obviously, they're still early days in their business, so their EPS isn't going to grow as fast as a company that's more established. They're more so focused on free cash flow and building up this revenue, because their revenue is only at 2.6 billion right now. So massive opportunity here, massive growth ahead, and just another company that I'm really looking to invest in June, and continue to invest in as if they continue to fall lower on the margin of safety, which they already did during the whole April stuff.